Hello everyone and welcome to the very first episode of Personal Finance Night. So at Personal Finance Night, we talk about everything related to money, building wealth, investing, and protecting our assets. The channel is mainly geared towards real estate investing. That's something I really love to do, and that's where I have some knowledge. I'm still learning every day, but let's get it going. So for this first episode, and since it's tax season, so today is March 30th. Happy Easter, by the way, everyone. I was thinking let's talk about taxes and mainly two components in the tax system that everybody needs to learn and start to use and take advantage of them. And these are tax deductions and tax credits. If you're only watching like 1 or 2 minutes, I'm gonna tell you right off the gate, tax credits, so both are awesome and we should learn them, but tax credits are the creme de la creme when it comes to tax savings and tax strategies and tax planning tools. And I will explain why. I will show like an example. So I printed out a summary of a federal income tax summary. So it's kind of like a statement, income statement, and it's part of my filing for 2023. I am not using my numbers for obvious reasons, but I have the structure and the statement. The statement is real, and the items that show on the statement are also real. So tax deductions are mainly, as the name implies, are reductions in the taxable amount. So let's say your taxable income is 100K. You use your deductions, your tax deductions, to reduce that taxable amount. So if you reduce the chunk of the chunk of income that is going to be taxed, and since taxes are a percentage of our income, they are not a flat fee or a flat amount. Since it's a percentage, let's say 25%, if you reduce your taxable income, then automatically you reduce the amount of tax that you need to pay on that income. So that's tax deductions. Now, why the reason I said tax credits are superior or are the creme de la creme in tax strategies, it's because they come after you have deducted your itemized deductions from your taxable income, and they come after you have calculated how much tax you owe to the IRS. And they are a reduction in the tax amount. They are not a reduction in the taxable amount. They are a reduction in the tax liability amount. So think about them as if you have already paid the IRS these taxes. They are kind of like a prepayment. So since you prepaid, let's say you owe your liabilities $10,000, you already prepaid $5,000. You did not, but let's think about them as such. Now you owe only another $5,000 because you prepaid $5,000. Okay, so now I'm gonna switch and show you the tax statement that I was referring to. Okay, here we go. So this is a federal income tax statement, tax summary, okay? It starts with income, your gross income here, and AGI, the adjusted gross income here. So in our example, we're gonna use 100K for adjusted gross income for easy math, okay? And then you have the itemized deductions, okay? And then you calculate your tax, and only then you are going to use your tax credits to reduce your tax amount, okay? This is why I said that tax credits are superior to tax to deductions. Okay, so in our example here, you have your AGI, you made 100K. So our goal is to reduce how much we owe the IRS in taxes, right? So we're gonna have or use some itemized deductions that everybody should think of, and should start planning their life around them. And they can happen for most of the part. They happen naturally, because what are they? These are taxes. One of the deductions, one of the biggest tax deductions, are taxes. How much taxes did you pay on a local level? And the max is 10K. We're capped at $10,000 in tax, and this is property tax, for example. Okay, so if you own a property, if you own a primary residence and you paid property tax on it, you can deduct from your income, from your 100K, you can deduct up to $10,000. So now you're gonna be taxed on 100 minus 10, which is 90K, $90,000. You're gonna be taxed on $90,000 instead of $100,000. Okay. Now, because you also own a house, a primary residence where you live, you also have interest, because you have on your mortgage you have principal, that is the amount you borrowed from the bank, and you pay back the bank, but the bank makes money, and that money, that profit, is interest. Okay, so because you have mortgage, you can deduct the interest section of your mortgage. You also have contributions you can deduct, and hopefully, you're donating, you're making enough money, and you can contribute and donate to charity. Now you end up, in our example, let's say between our mortgage and our taxes, we have 40K in mortgage. Our total deductions are 50K. What does this mean? It means that I'm not gonna be taxed on 100K. I'm gonna be taxed on 50K instead. Okay, here. Okay. The standard deductions are $27,000, because 50K is higher than my total itemized deductions are 50K, which is higher than the standard deductions, which everybody gets. Then I'm gonna deduct my AGI by 50K, just like I said. I skipped a step earlier. Okay, I didn't explain this, but I'm explaining it now. So now my income, my taxable income, and I say taxable income, is 50K only. So I have to pay tax on 50K instead of 100K. This is why itemizing your deductions, if you can, and you should plan your life around being able to itemize your deductions, is very important. So number one strategy is to itemize deductions, and do it, of course, in a legal way. Okay, you own a house, you own a primary residence, you can itemize your taxes and your local taxes and your interest. Okay, so now let's say your bracket, your tax, roughly you pay 12.5%. Sorry, you pay 25% in taxes. Okay, if you did not have any deductions, not even standard deductions, okay, not even a 27K, let's just assume you are in the 25% bracket, so you have to pay 25% tax on your 100K adjusted gross income. That would have been $25,000. But because you have itemized deductions of 50K, now your taxable amount is only 50K, and your tax bracket, let's say, is still 25% for the purposes of this example. What's 25% of 50K? That's only $12,500. So your tax liability went down from $25,000 if you were gonna pay tax on 100K to only $12,500, and this is thanks to your mortgage. This is thanks to owning a house. basically, a primary residence. Okay, now watch this. So you owe, we said you owe 12,500 in tax. We're not done. You have tax credits. This is why credits are superior. So deductions are a reduction in the taxable income. Taxable income of 50K versus 100K. They are a reduction in the taxable income. Credits, however, are a reduction in the tax amount, in the tax that you owe. Okay, now you owe 12,500. Let's say you have credits. Let's say you bought a new EV, okay, a new electric vehicle, and your income is under a certain amount, okay. You get to deduct 7,500 or up to 7,500, okay, depending on the model and your income, I believe. So if you also have here in my example, I have, or we have replaced our insulation in our primary residence. It was very outdated. We changed it, replaced it with an up-to-date and an upgraded insulation that qualifies for tax credits up to 1,200. So the total cost of the project was $5,000. We can deduct 30% of $5,000. That's 1,500. Okay, roughly. But the max is 1,200. So here I'm claiming 1,200 in tax credits. Okay. And same goes for when you install a charger at home. That's the alternate fuel vehicle credit. So there are many credits. They are mainly related to energy and reducing our carbon footprint, because the government is encouraging us to reduce our carbon footprint and to use a renewable energy instead of fuel generated energy. So the government encourages that, and to do that, they don't just talk about it, they give money through tax credits to us. So we invest in things like that, because we changed our insulation, we replaced it with a better insulation that is more efficient. We're gonna use less energy to heat our house during winter time or to cool it during summertime. So because we use less energy, then we pollute less, okay? And we collect tax credits for that. Obviously, this is only the year you install your new insulation or you buy your new car, but you have to plan and think of when do you want to do these things. You probably want to do them when your tax is the highest or when your income is the highest, okay? So let's say here our total tax credits were $10,000, okay? Now, what happens to our $12,500 in tax liability? This is where the magic happens. It's gonna become only $2,500 because I'm gonna deduct $10,000 from 12,500. That's how tax credits work. Remember, it's as if you have already paid a portion of the tax. That's the magic of tax credits. Okay, so now my tax is only 2,500 instead of 12,500, or instead of $25,000 if I didn't have any deductions. Okay, so we have to learn these and educate ourselves on these tax credits, so and tax deductions as well. So we start reducing our tax or our tax liability. Now, what happens to your actual tax bracket or percentage? So it goes from, if I was gonna pay 12,500, you now pay So that's 12 on a 100K income, that's 12.5%. Now, because we're gonna, in our example, we're gonna pay only 2,500. Now, tax bracket or the tax percentage goes down to only 2.5%. So on 100K, you pay only 2.5% in this specific example. Obviously, the numbers, we have to revise them and use real numbers, but this is how tax works. This is a real federal income tax summary. It's a real statement, and these are real items that go on your tax statement, okay? We can all make it happen, but we have to educate ourselves. Hopefully you liked the video, and hopefully I was able to provide some good information and educate you on how on two important items of the tax. If you liked the video, please share it with other family members, friends, so everybody gets educated and we all get some tools to reduce our taxes and to have a better financial personal finance education and personal finance overall. Please like, comment, and subscribe. Let's get this to more people, and thank you for watching. See you next time. Bye now.